Hey there, fellow traders. Welcome back to our YouTube channel. Today, we're diving into one of the fundamental pillars of trading success, understanding supply and demand. By the end of this video, you'll not only have a solid understanding of supply and demand dynamics but also practical strategies to implement in your trading routine, ultimately boosting your win rate and maximizing profits. So, grab your notebook, buckle up, and let's dive deep into the world of supply and demand. Don't forget to hit that like button and subscribe for more valuable insights to elevate your trading game. Let's get started. What is supply and demand in the context of trading? Supply and demand refer to the relationship between the quantity of a currency available in the market and the desire of traders to buy or sell that currency. When demand exceeds supply, the currency's value typically rises, and vice versa. Supply and demand can mean different things to different types of traders. For technical traders, it often translates to support and resistance or trendline channels. But for us smart money traders, supply and demand refers to something more precise: order blocks. Demand occurs in an uptrend when buying pressure outweighs selling pressure. When there is a large volume of buy positions within a specific zone in the market, that zone becomes a demand zone. We then identify our order block within this zone and anticipate buying opportunities from it in the near future. Conversely, supply occurs in a downtrend when selling pressure outweighs buying pressure. When there is a significant volume of sell positions within a specific zone in the market, this zone transforms into what we call a supply zone. We then identify our order blocks within this zone and anticipate further selling opportunities. Since supply and demand is associated with order block in smart money trading, it is important to remind each other about characteristics of valid order blocks. Firstly, your order block must be unmitigated, meaning it shouldn't be retested by subsequent candle wicks. Remember, order blocks are a one-time use. Secondly, it must create a fair value gap. This gap creates an imbalance in the market, resulting in the market to pull back and fill the gap, providing us with trading opportunities. Lastly, the order block must result in a break of structure, signifying that the overall market momentum is in that direction, ensuring safer trading opportunities. These are the three characteristics that have to come together for an order block to be valid. Let's put our knowledge into practice with this price chart example. A clear break below this low signals a change in market character, indicating a shift to a downtrend. Now, let's identify valid supply zones for potential selling opportunities. We spot this candle as our supply zone as it meets all three characteristics of valid order blocks. We then wait for a pullback and retest. From here, we execute sell orders with stop loss above our supply zone and take profit below the swing low. As expected, price drops and hits our target. Another break of structure suggests the market sentiment remains bearish. We identify yet another supply zone and wait for a retest. Price taps our supply zone, providing another solid entry setup to sell, resulting in a successful trade yet again. Price breaking below this low unveils another supply zone. However, it's important to note a key principle: the further the downtrend progresses, the less reliable our supply zones become. Eventually, price dynamics may shift, leading to a trend reversal. Supply zones located at the beginning of the trend hold greater reliability. As we move further away from the start of the trend, the reliability of supply zones diminishes progressively. Let's return to our analysis. Price retested our supply zone, prompting us to place sell orders. However, recognizing that our supply zones are now less reliable due to the progression of the downtrend, we opt to risk less per position. Fortunately, price falls and hits our take profit. With another break of structure and a new supply zone in sight, we await a retracement and retest. Again, we enter sell orders, this time with reduced risk per trade. Once more, price moves in our favor, hitting take profit. The pattern repeats as price retraces to retest our supply zone, offering us another opportunity to sell. Unfortunately, this time we hit stop loss. However, our risk management strategy pays off, as we've avoided significant capital loss by risking less on this trade, given the decreased reliability of the supply zone further along the downtrend. With price breaking above the swing high, signaling a change in market character and indicating a trend reversal, our focus shifts to identifying demand zones for potential buying opportunities. While this candle appears to resemble a good demand zone, it's already retested, rendering it invalid. Remember, supply and demand zones are one-time use. However, the demand zone located here meets all the requirements. We patiently wait for price to retrace back and retest it. We then confidently place our buy orders. Given that this demand zone is at the start of the uptrend, it holds greater reliability. Consequently, we're willing to risk slightly more on this trade, but we emphasize the importance of not over-risking. As anticipated, price moves upward and hits our take profit, resulting in a successful trade. Throughout this demonstration, we've walked through the crucial steps of identifying supply and demand zones before executing trades. However, our journey doesn't end here. While understanding these zones is essential, it's not enough on its own to significantly improve your win rate. Now, let's delve into some invaluable tips and tricks to elevate your overall supply and demand trading strategy. When analyzing the market on lower timeframes like the 1-hour, 15-minute, or 5-minute charts, a typical trade setup might show up where you risk around 10 to 15 pips, depending on the instrument being traded. This level of risk is favorable, particularly for beginner traders with smaller accounts. However, when trading higher timeframes such as the daily or 4-hour charts, the risk per trade could easily escalate to 40 pips or more, which may not be ideal for those with limited capital. So, how can we ensure that we always execute our trades while risking less? Let's explore two methods to achieve this using the example on this price chart. Starting from the daily timeframe, it's evident that we're in an uptrend, as indicated by this break of structure. Price is still trading above our swing low, signaling that we should be on the lookout for buying opportunities. We then identify this higher timeframe demand zone. However, if we were to buy from this demand zone, we'd be risking more than 100 pips, far more than what we aim for. So, what can we do to mitigate this risk? The first method is straightforward: simply drop down to a much lower timeframe. Here, we can refine our demand zone to fit the current market price, making it smaller and reducing our risk to about 40 pips. Now, it's worth noting that some traders, particularly professional traders with significant capital and experience, might still opt to place their trades at this higher timeframe demand zone. However, if you don't have the capital or experience to justify this level of risk, it's best to avoid buying here. This brings us to the other method, where we delve even further into a lower timeframe to observe how price reacts at this demand zone, thereby seeking a safer entry. What we're looking for in this timeframe is a crucial shift in market character, price breaking above this high. This signals that the bearish momentum is depleted, and a potential reversal may be underway. Once we've identified this change, we turn our attention to finding a demand zone. Upon locating one, we patiently wait for price to retest it. When the retracement occurs, we place our buy orders, setting our stop loss below the demand zone and aiming for take profit levels higher up. By employing this method, we've effectively reduced our risk to 15 pips or less, a significant improvement from the initial risk exposure. This should be the goal for every trader, especially those just starting out. I emphasize this approach for a couple of reasons. Firstly, it ensures that we're not trading against the prevailing downward momentum of the market. Secondly, it substantially reduces risk while maximizing profit potential. Let's delve into another fundamental aspect of the market: liquidity. In essence, liquidity refers to the ease with which a currency pair can be bought or sold in the market without causing significant price changes. However, big institutional traders often leverage this concept to manipulate retail traders for their own benefit. You see, institutional traders execute large volume trades, which require a lot of liquidity. To access this liquidity, they strategically create short-term price movements, such as this double bottom pattern. These patterns often lure technical traders into placing their buy orders, with stop losses positioned below. What happens next is crucial. These stop losses generate the liquidity that institutional traders require. They push the price down, triggering these stop losses and creating a surge in selling pressure. This enables institutional traders to enter their buy orders at more favorable prices. Once their orders are filled, price rapidly moves to the upside, often catching retail traders off guard. Liquidity traps come in diverse forms, each designed to manipulate retail traders for the benefit of institutional players. Let's examine three prevalent types. The first type often presents itself as double tops or double bottoms. Here, technical traders typically place sell orders at the retest of these patterns, setting stop losses above the resistance. These triggered stop losses generate liquidity, facilitating institutional trading strategies. Another common liquidity trap involves trend lines. Technical traders commonly position buy orders as price retraces to retest the trend line, with stop losses placed below. These stop losses serve to provide liquidity for institutional traders to execute their orders. Lastly, liquidity traps can manifest as order blocks. When two order blocks stack on top of each other, the first block acts as an inducement, enticing smart money traders. As they enter positions, liquidity is generated below. Recognizing these prevalent types of liquidity traps empowers traders to align their strategies with institutional players, potentially enhancing their trading success. Let's demonstrate this with a real price chart. The break of structure shows we're in an uptrend, so we're eyeing buying chances. We identify this clear demand zone. When institutional traders want to buy from this zone, they might create temporary price movements like this double bottom to tempt traders into buying, creating a lot of liquidity. Then, they push the price down to access this liquidity and place their big trades at this demand zone. After that, the price usually shoots up. So, always spot these areas with lots of trading activity and trade in line with the big banks. Another crucial aspect that took me some time to grasp is that for a demand or supply zone to be considered a high probability setup, it must swap liquidity. Now that the price has swapped the liquidity resting below, there's no need for institutional traders to manipulate the market. With these conditions met, we can place our buy orders confidently. However, if your demand zone didn't swap the liquidity below it, this creates a double bottom pattern, leaving lots of liquidity below. Institutional traders will then drive the price down to a nearby demand zone to access this liquidity. As a result, the price will shoot straight up, causing all those who placed buy orders at the initial demand zone to lose their trades. Let's examine this price chart example. We're in an uptrend, as evidenced by these subsequent breaks of structures. We identify a demand zone where we can potentially buy. However, price fails to swap the liquidity resting below, resulting in the formation of a double bottom pattern. Double bottoms tend to generate substantial liquidity below them. Recognizing this opportunity, institutional traders push the price down to a nearby demand zone to access this liquidity. This action takes out all your stop losses before the institutional traders eventually place their large volume trades, significantly pushing the price up. This highlights the importance of correctly identifying areas with liquidity to avoid losses and align trades with institutional traders. These are some of the tricks and tips you can use to enhance your supply and demand trading strategy. What we've covered here are confluences, and remember, the more confluences your setup has, the higher the chance of winning that trade. So, always be on the lookout for these fundamental concepts. If you found this content valuable, please like and subscribe to help us grow and upload more insightful videos. See you in the next video.